if you have business partners, one of the most stressful financial situations you probably could ever come into is the premature passing of one of your partners. So basically one of your business partners dies unexpectedly, and now you have to somewhat scramble to have the funds to buy them out to basically allow the company to continue and for that partner's family to get the value they deserve. So I'm going to walk you through some of the worst ways to fund a buy-sell agreement, and obviously one of the best ways as well. So let's say you have business partners, business owner 1 and business owner 2. Now they are 50-50 owners of a company, and say the company is worth $10 million. So owner 1 has $5 million worth of value, and so does owner 2. If owner 1 were to pass away, the question is, how does owner 2 come up with $5 million to buy out owner 1's shares? If you take out a loan, it may be an option, but it's a very expensive way to solve that problem. You could do it in cash, but now you're most likely draining the company bank account, and not many people have $5 million in cash willing to basically liquidate out of the company. So the solution is going to be, you're going to have your corporation, and the corporation is going to buy a $5 million life insurance policy on owner 1 and a $5 million life insurance policy on owner 2. So if owner 1 were to prematurely die, $5 million gets paid tax-free to the corp, and owner 2 would take the $5 million to buy out owner 1's shares. Now with this, there's a few different strategies you can implement. There could be a share redemption strategy, a promissory note strategy, a crisscross strategy, but ultimately the funding is coming from the life insurance policy to buy out owner 1's shares. So owner 2 walks away with the company, which is great, but I think it's not talked about that much, but owner 1's family was banking on this value while they were alive. So if owner 1 passes away and the company can't afford to buy out owner 1's shares, owner 1's family is now also financially suffering, not to mention losing a family member. So you want to make sure that you're doing this not just for the longevity of the company, which may have employees, but you're doing it for your own family as well, to make sure that the company or owner 2 has enough money to buy out owner 1's shares. So mathematically speaking, using a life insurance policy to fund the buyout is exponentially better than using cash, a loan, or liquidating any other asset. So if you have business partners, I would sincerely look at a structure like this. And one thing to point out, in the shareholders agreement, it is very important you mention the CDA. Now the CDA is the capital dividend account credit the corporation will receive once owner 1 passes away, and that means that the money can come out of the corporation tax-free to go to owner 1. So if you don't have this in the shareholders agreement, there is a chance that the $5 million would be completely taxable, which would only leave owner 1's family with about $2.5 million. So you want to make sure you include in your shareholders agreement that the life insurance proceeds have to go through the CDA account, and that way you're going to ensure that the full $5 million or whatever the value is goes out of the corporation completely tax-free.